started in just a couple of minutes, right around 12 o'clock West Coast time. Thank you. Well, good afternoon, everybody. I'm Eric Patton. I'm the Chief Investment Officer here at Cutler, and my watch says it's 12 o'clock here in Seattle, so it's officially afternoon here in Seattle, and I want to thank you all for joining us today. Today, we're going to be talking about health savings accounts, and Cutler's Chief Operating Officer, Brook Anderson, also a financial advisor here at Cutler in our Bellevue office, is going to be walking us through what these accounts are and how they may be beneficial for each of you. And I do want to let you know that a copy of this presentation will be available afterwards on our website at cutler.com. There's a lot of detail that Brook's going to run through. He may not touch on everything on the slides that you're going to see. And if so, you're welcome to go back and revisit those slides on our website. But Brook, thank you for preparing this presentation for us today, and take it from here, please.
All right, thank you, Eric, for that introduction, and welcome. I'm glad you could join today. I will take care of a little bit of house cleaning here before we jump into the details. Specifically, I just want a disclaimer, just wanted to make sure that everyone knows this presentation is for educational purposes only and is really meant just to provide some information for your consideration and should not be considered as an advice or as a specific recommendation to take any action. And again, we do rely on some third-party information in this presentation that we believe is reliable, but we can't make any guarantees on that information either. And we don't generally provide tax advice as an organization. So with that in mind, I am going to dive in. Today, a very exciting topic. We're going to talk about how to maximize your HSA account and how to get the most value out of it. So anyway, very exciting topic for me. I think you're going to enjoy this. I just want to kind of give a high-level picture of where we're going. And that is, I want to change your thinking about how you look at an HSA account. Instead of a medical savings account, I want you to start envisioning it as a retirement account, similar to a 401k. We're going to talk a lot about what the benefits and from a tax perspective, how they're similar to 401k plans or other retirement investment vehicles. But that's the big picture, is how do we start thinking about this as a retirement vehicle and taking advantage of what really is the most tax advantaged account available to us today. So I'm going to start with something I refer to as the hierarchy of savings. What this is where would I put the next dollar of savings if I have that available and I don't have any specific purposes? What I mean by no specific purposes, if you said, for example, you're saving for a house that you want to buy in 3 years or something like that with you need a down payment, I'm not going to have you put that money in your 401k. That makes no sense. But if there's no impediments on those dollars and you have an unlimited or a long time horizon, this hierarchy, basically driven by taxes, will show you where the next dollar is most advantageously invested. And I always start with emergency fund on the top. You don't want to live paycheck to paycheck. You need to have some reserves for a rainy day if some event happens. I'll always encourage my clients to fund that first. But look at number 2. What is number 2? HSA, money that's going to be saved for the long term. And what's the target amount? It's to the extent that they're matched by the employer or provided for free. Free money is something you should always take. So again, the first component of the HSA is what your employer is going to give you for free. If that requires that you provide some funds, then I would absolutely recommend you do that. After HSA, you'll see that number 3 on my list is a 401k to the extent that dollars are matched. So if they're matching both, I would match the HSA in priority over a 401k. What about number 4? Once you've maximized the free money, where does the next dollar go? If you have any high interest debts like credit cards, maybe some personal loans at a bank, something of that nature that are high interest bearing, I would pay those off next. And then number 5 on the list is now I'm contributing my own money that isn't being matched. That is the next best place to put it. And I'm just going to stop there on the list and just say in that hierarchy of savings, HSA rates very high because of its tax advantageness. And there are limits, and you can see those on the right. Some are age-based, and some have to do with whether you're a family or an individual person. And I'll get into a little bit more of that as we move forward. So let's start with what is an HSA. An HSA is a health savings account. It's a type of account that was created by the 2003 Medicare Modernization Act. And really what it is, it was meant to be a place to put some exempt dollars that you could then use to cover medical expenses. And that's what its purpose was. Who qualifies for this type of account? Only those who are covered under a high deductible health plan. And most employers today offer a variety of health plan options. And generally speaking, a high deductible plan is always going to be one of those options. And I'll take a moment just to mention here that I generally wouldn't recommend choosing a health plan specifically for the HSA if the health plan matches your health needs and makes sense from your health priorities. Then that's a great option. If that happens to be the best plan for you, and there's a lot of things to examine on that side of things, as long as that is the best option for you, and it has a high deductible plan, what a great benefit you now have before you. By the way, who also does, when you talk about who qualifies for an HSA, I should mention there's a couple disqualifiers. One, you can't be in Medicare, so you must be prior to Medicare, and you can't be covered under another medical plan, say your spouse's. I'm not going to go over the whole list, but those are a few of the qualifications to having an HSA account. And some of the benefits, I just want to tap on a little bit high level. We're going to dig into these more as we move forward, but they reduce your taxes. They're going to help save you on medical expenses. And unlike other health savings vehicles, this is not a use it or lose it type of an account. You keep the balance forever. It is yours forever, and you control it. You can move it to a different provider if you choose, because you like different investment options at a different place, you're more than welcome to do that. So there's a lot of benefits to this particular type of health savings account. We've talked a little about taxation and we've hinted about all these benefits. I want to reveal them to you. There's really kind of three areas or three elements of tax savings here. First of all, you make contributions generally from your payroll that are pre-tax. So you don't pay any tax at the time you contribute the funds. Kind of similar to a traditional 401k plan. That money is not part of your earnings for that year. Then the money that's been deposited in that HSA account grows, the earnings grow tax-free. You don't pay any income tax or any gains on that account balance as it grows. And then lastly, that third bullet at the top, distributions. As long as those dollars go to pay for qualified medical expenses, there is no taxation on the distributions of those accounts. Now, there is taxation if you spend those dollars on non-qualified medical expenses. If I decided to take the money out and buy a new car, I'd be assessed with ordinary income tax. And if I was younger than age 65, I would also have a penalty, a 20% penalty, pretty steep. So you really want to target using these funds for medical expenses, but not now, in the future, when you're retired, or as late in life as possible. We'll talk about that in a minute. And I don't want to go over an exhaustive list. There are hundreds of things that qualify as a qualified medical expense. And I just highlighted a few of these, partially because some of them will surprise you. Band-Aids and sunscreen. Wouldn't have thought that. I'm a glasses wearer. This would also include even wipes for my glasses. I found that on the list. I thought that was funny. But there are a lot of things you might not expect that are everyday items that might qualify. Certainly your Medicare premiums, things of that nature, and all the obvious expenses that you incur at a doctor's office will be covered. And on the non-qualified medical expenses, really kind of think about what is prescribed by a doctor. If you're in question, usually it's around, was it prescribed or not? For example, weight loss programs. If it was prescribed by a doctor, probably covered. If it was not prescribed by a doctor, probably not. Same thing with elective cosmetic type procedures or supplements. Again, if they're prescribed by a doctor, they're generally going to be covered. So an HSA account, generally people think about this as being a repository for funds that you're just going to unload as you incur medical expenses. That's the traditional approach, is it's a piggy bank for your medical expenses as those medical expenses are incurred. What I want you to try to think about, this is what I'm calling my approach, is think about those funds as being a retirement account. And you're not going to spend them on everyday medical expenses. How would I suggest you pay for those otherwise? Out of other funds, whether you cash flow that or you take that out of whatever savings you've set aside to cover those expenses. Again, if as I come back to that very first slide when we talked about, I would preference my HSA even over my 401k. If I had to contribute a little less to make ends meet in my 401k so I could make this work and that extra savings would cover my medical expenses today, that's what I would do. And what we're talking about is thinking about that account in a totally different way. Again, this is going to be think of it like a retirement account that you want to stretch out as long as you can in life and not use that as your piggy bank for current medical expenses. And I want to highlight here the reason for this. It's the most tax advantaged account in America today. There is no other account where you can accumulate and invest funds where there is zero taxation if it's used for medical expenses. Again, compare it to your 401ks, your IRAs, your 403bs, any other form of retirement account you can think of, and you'll notice there's taxation at some point along the process of you depositing and or dispersing the funds. So again, this is the only account that is free of any taxation. So I want to talk a little about what are people doing with these HSA accounts today. And I like this graph because it really shows how much money is flowing into these accounts. They become very popular. What you see here are the annual contributions. That's the top line, the annual withdrawals, and the amount that has been retained in those balances by year. And you'll notice not only are they all growing pretty substantially, meaning HSA accounts have caught a lot of popularity and people are funding them at a higher level than they ever have. But what I'll also point out is that the withdrawals are very close to the contributions, meaning most people use it as a piggy bank. And if you look in that blue box, what percentage of Americans that have these accounts are actually investing the dollars? That's kind of my trigger, by the way, that they're using it as let's say a retirement vehicle, and not just that they had a little extra balance at the end of one year that's carrying into the next. If you're investing it, you're probably thinking about it more long term. Only 7% of people are investing the money. That means 93% are probably using it as a piggy bank. And look at the assets that are being invested. 32%, about a third of all the assets held in HSA accounts is invested. That 7% is aggressively saving. If you're in the know, I will say, and you're using this as this most tax advantaged account in America and you're trying to maximize it, that's why those balances that are invested keeps growing at such a high rate. It currently is at 32%. 33 billion across the United States has been invested and most likely being accumulated forward for use in retirement. So again, just one of those observations that makes me realize very few people are taking advantage of such a great account. So what we're talking about here is investing the money forward into retirement. So when you think about the investing of the dollars, think about it as similar to a 401k. Meaning if your time horizon is longer, you might invest differently than if it's shorter. And I would strongly encourage you, if you have questions about how best to allocate the funds in a 401k plan, great opportunity to reach out to your Cutler advisor, get some advice on what would make sense in that account based on when you're going to need the money. And again, I'll just I have this, my investment allocation 101, just as a rule of thumb. The longer the time horizon, you can generally be more risky. If you have a shorter time horizon, you generally have to keep those assets in a little less risk so that they're available when you need them. But the key here is to think of it and invest it like a retirement account, because again, that's our objective here, is to use that in such a manner. If I look at medical expenses in retirement, this is a question advisors always get asked. How much is it really going to cost me in medical expenses? And am I prepared for that expense? And I know this is a little bit shocking when you look at the chart on your right, but I wanted to spend a little time here because it's a big number. It's a big number. The red line, if I was a 50-year-old today, and this is for a couple, by the way, not an individual. So obviously the numbers are roughly half if you're just an individual. But if as a couple, if I was a 50-year-old couple today, and I'm going to, let's say I'll start my retirement at 65, how much might I expect to spend out of pocket for medical related expenses? And by the way, those medical expenses include my Medicare Part B and Part D premiums, along with other out-of-pocket expenses, co-pays and other out-of-pocket expenses. But if I was to estimate the aggregate of all of them for a person of average medical needs, that red line would reflect what that 50-year-old should expect, that 50-year-old couple should expect to shell out each year for medical expenses. Notice at age about 90, how much money per year is being spent. Now, those are future dollars. Inflation is a big part of those, as medical expenses are inflating at a rate that's been higher than general inflation. So it's even worse than what we'd expect from just applying a general inflation rate. But those are what the actuaries are anticipating seeing over that time period. And you might notice, why does it fall off on a cliff at the end? Unfortunately for us men, we generally don't outlive the women. In a typical couple, when the husband passes first, that's that big drop. And that last little bit is generally where the surviving spouse is now a single individual. That's why it falls off at the end. A lot less for if you were a 60-year-old today and going to retire at 65. Why? That difference is all medical inflation. I mean, so it's a big number. Inflation is a big component of this. Now, I want to focus on one other element real quick, and that is, if you were to try to accumulate some savings to cover all your medical needs in retirement, how much might you need to tuck away? If I was that 50-year-old couple today, retiring at say 65, I would need to save a lump of about $800,000 to cover my future medical expenses. And that's assuming I'm in the lowest IRMA bracket. And of course, what's an IRMA bracket? As your income rises, so does the premiums that you pay for Medicare premiums. So your Medicare premiums are based off of your income. If I'm in the lowest IRMA bracket, I would need to save about $800,000 to fund all of my medical expenses, assuming I'm growing it at some 6% rate. If I was in the highest IRMA bracket, and by the way, those are at wage levels of say $750,000 a year, pretty high. If I was in those kind of income levels in retirement, I'd be at the highest IRMA bracket, and I would need to save more like 1.4 million as a 50-year-old couple by the time I hit age 65 to cover those medical expenses. So very high medical needs. And the reason I point this out is that the odds that you will save too much to cover your medical expenses via this tool, this HSA account, unlikely. Unlikely you'll save as much as it costs. Could you? Yes. And I just want to point out one example. We talked about when this launched many, many years ago. If I was a 50-year-old today, I could have started contributing to this when I was 31 years old, if I'm 50 today. If I had contributed the maximum amount as a family, starting at age 51, growing at about 50%, and I had the same scenario you see in front of you, I would have accumulated approximately $800,000. I would have had about the amount I needed. So it just about covered it for my expenses during my retired years. So again, big numbers. We're talking about big numbers here. So if we talk about that saving and investing part, what about how you unwind those assets? Eventually, you've got this nice nest egg, let's say, built up in that HSA account. Eventually, you need to use it, and you're going to start applying it. Is there any strategy to when you disperse those dollars? There is. And what I'm going to tell you is, first of all, an HSA account is not an ideal estate asset. What do I mean by that? I mean, if I had all the different account types available and I was going to pass away with money left in my estate, this would not be one of the ones I would want with a balance. Why? Because as soon as I pass away, those funds will go to my heirs, but they'll become immediately taxable in my estate. My estate will pay the income tax on all the unspent dollars because they were never taxed before and they never got used for medical. So I will pay the income tax on my final tax return, and my heirs will receive an after-tax amount. I'd rather give them even an IRA or any other account, probably not this one. So again, the idea is use it up while you're in your retirement. Don't use this as an estate asset. And then I want to just kind of touch on a little bit of what is the conventional wisdom when we talk about unwinding assets. And it just kind of gives it's a little rule of thumb. And it basically says that when you're unwinding, this isn't related, by the way, to HSA accounts. It's in general. If I had assets in different kinds of accounts, how might the order in which I deplete those accounts come if I'm going to be strategic? The conventional wisdom says spend the taxable money first, maybe that taxable brokerage account, followed by my tax deferred accounts, which are my IRAs, my 401ks, and then lastly, spend the tax exempt amounts. Those would be your Roth accounts and, as we talked about, your HSA account because it's free of tax. So those would be the last in general. And there's all sorts of strategies around those. You wouldn't want to follow that legalistically, but as a rule of thumb, that's the right order. And what I would say is if you're trying to preserve it to the end, each person's situation might be a little different. A bigger balance might be able to delay longer, or I'm sorry, might be able to use those dollars faster or earlier in their retirement. If I had a very small amount, I might push them to a little bit later in my retired life. But the idea is you want to deplete them all and use them all within your life. So don't push it to the very edge. But depending on how big your balance is, you can spread it out over a longer or shorter time period within that window of time. Again, this is a great opportunity to talk to your Cutler advisor and ask their opinions on how you might unwind those assets. Again, those are some strategic elements come into how you might do that across all your accounts, this being one of them. And there are strategies around how to do that most efficiently. So definitely one of those questions to ask your advisor about and how to do that in the most efficient manner. So I wanted to share 2 HSA providers that I think are great amongst the list. If you have the choice to pick which ones you want, and by the way, before I jump into this, I actually should probably tell you, when you're doing payroll withdrawals because your company offers that high deductible plan, you're almost always going to be routed into the provider of your employer. And there's lots of these plans. So they're going to put you into their plan, and you're going to then contribute via payroll withdrawals to that HSA provider they've selected, and you use it whenever you feel fit. Again, my suggestion, wait till very long later in life and invest it along the way. But again, you're using their plan. Remember how I told you that you have full control over this account? Just because it goes into your employer's provider, and let's say you don't like their investment options, or maybe their fees are high, and you say, I really don't want to accumulate a big amount, but I plan on working for the same employer forever, you can move those funds anytime you want. You can move them to another provider. It's not necessarily a fast process. It's a little bit cumbersome. You have some paperwork to do, but you can move those into the most advantageous account for you. So there's a lot of providers out there, and there's more and more every day because those accounts are growing so high in value collectively. So what I would say is, I did an analysis looking at all of the largest players out there and compared their fees, the array of investment options that you might have available within their plans, the minimum required balance to open a plan, and as well as how much of that balance has to remain in cash. And by the way, that's kind of a new thing I just introduced. Some plans require you're not allowed to invest all of the money. You maybe have to carry a cash balance. Maybe that cash balance is $1,000, maybe it's $2,000 or $3,000, but there could be some amount that has to remain in cash. And why might they do that? Most of the time, employers don't want you to get into a situation where you have an emergency room visit and you need the money and it's sitting in an investment that has lost half its value and you don't have the cash to pay for it. So they might have a cash holding requirement. But again, I would rather see the least restrictions on the account in my preferencing. And these 2 providers have risen to the top, Fidelity and Lively. Lively is a much newer one and growing very fast. Fidelity's been around for a long time. What I would say within Lively, just as a side note, is Lively also has a relationship with Schwab. And you can invest in anything that Schwab would allow you to invest in say, your normal IRAs or anything else. This could allow you to even give visibility to your Cutler advisor and help you manage that account. So just something to keep in mind. They do have that relationship with Schwab. I did provide the links to both of those plans. They're both very easy to open and start making contributions to them. I'm not going to spend any time here, but just to point out, there are many, and I just highlighted a few here without going into a lot of detail. And I'm just going to highlight one for you on this list. You can come back and read this if you want to dig into this deeper. And that's the first one. I've had many questions asked about a first to die. What happens when the account owner, let's say it's myself, and I pass away? What happens to my wife? It passes on to my wife, and it's treated like an HSA, even though the account was in my name. So amongst spouses, it passes on and lives on, but not when the second to die. Remember, I told you on that second to die, it's different. It becomes taxable to the estate. There are numerous special circumstances here. This list doesn't even include them all, but I highlight just a few of the most common questions that I've been asked or that have come up in conversations with my clients. But I will tell you that there are many, and if you do have questions, you reach out to your advisor, and certainly they can give you some insights as to some specific things that might impact you. So anyway, with that, that's going to conclude our presentation. As you can tell, I love this topic. I think it's one of these very underutilized, great opportunities for people to take advantage of, and very few people do it. If you need any help or any assistance in getting one of these set up, or are you eligible, or how should you manage it, just reach out to your advisor. We'd be happy to give you insights and help on all of that. And with that, I will let you go to your day. And I just appreciate you spending some time with me this afternoon, and have a great rest of your day. Thanks so much.